you're dialed in to the Retirement Income Source, we thank you for joining us and spending some time with us today. I'm Tim Sparks, and as always, we help people, show people, pre-retirees and retirees, how to invest for income the old-fashioned way. It does make a significant difference. You know, I've been doing this business for 20 years, giving financial advice specifically focusing on retirees and pre-retirees. And, you get pretty good at something, even though I'm still learning. I'm not saying I ultimately know everything, because I don't think none of us know everything. That's not my intent. But, just like I tell people when they come in with their profession or whatever that may be, I said, you can probably tell me anything I need to know since you've been doing it for 30 or 40 years. And so you got to keep in mind, we're living in a time now where people, especially when they want to get retirement advice, if they're going to pay for retirement advice, pay a financial advisor, then they want to get, somebody that really knows the ins and outs of the industry, and most importantly, how to get them the most mileage out of their money. I'm surrounded by a team of professionals that are superior to what they do. They're specialized in certain arenas that I don't need to. I don't need to know everything. But I'm smart enough to know where to get the right advice, especially when it comes to retirement, because I have been on the side, and the very side that I sometimes am critical of was the very area of expertise where I thought I wasn't no expert at all, of just helping people to get the most mileage out of their money by spending their principal. And I was doing that for like 14 years or so. And if you think about it for a moment, whenever I made the transition into investing for income, I can tell the difference. I can tell the difference in our clients as they continue to smile all the way to the bank, collecting those dividend paychecks and not having to stress over where their income's going to come each and every month. In other words, they're laughing and smiling all the way to the bank. Most people, unfortunately, can't. They can only laugh or smile when the markets are doing well. But when the markets are not, typically they'll pull back and they won't even take income. And that should not be what retirement's all about. You saved, you scrimped, and you stepped into retirement. And if you think about it for a moment, who wants to sacrifice time in retirement? Stop doing the things that you were actually hoping to do, that you had goals to do, maybe bucket list to do, and then now you're had to put on the brakes, tighten your wallet so that way you can make sure that your money gets back to normalcy, because sometimes getting back to normalcy can take quite a long time, especially if you're a student of market history like I am. That's the reason why we like to invest for income. And so today we're going to be talking about making sense on income, but in a lot of ways. Why I believe it's the optimal choice for people in retirement. Keep in mind, when the markets go down like they did 2013, for 13 years, nobody made any growth on the return of their money. Imagine being down, in other words, trying to recover, and being down for 13 years, no returns whatsoever on your money. Now, some people may not know what I'm talking about. What I'm talking about is the S&P 500. The NASDAQ actually took slightly longer than 13 years to recover. So, because if you take a 50% hit, like the markets did in the early 2000s, roughly, and then a 60% hit in the financial crisis in 2008, you got to realize when you take a 50% hit, you got to double it to get it back. That doesn't happen instantaneously. And keep in mind, you got to be able to understand that math, when it comes to percentages of losses, takes more to get it back. If you take $1, squash it down to a 50-cent piece, you got to double it to get it back. And if you're taking income and you stepped into retirement back in the early 2000s, I hate to tell you, that's the reason why that we're trying to help people to make sense of income. But if you were investing the way most people are investing that come in our office today, 99% of the portfolio, By the time you got to 2013, because of that no return, zero growth, you didn't get any assistance, which you needed when you step into retirement, which is not talked about and can happen. The fact that it happened once doesn't mean it can't happen again. It's not if, it's when it's going to happen again, and are you prepared? That's it. I mean, right now, I think we've kind of gotten too accustomed to thinking that the markets are not going to come back down. By maybe looking in the rearview mirror, that's, maybe the government's going to keep on printing money and just keep bailing us out. Well, I don't believe so. I don't think that they're going to continue to do that. They can't do that. We can't continue to buy our way for you to have a good, comfortable retirement plan by continuing to add money, print money, and put it into the economy so that way it drives the economy. And believe it or not, back then they had to do that in order to be able to get the markets back to normal. But it took 13 years to do that during that time frame. And if you were again in retirement, that wouldn't have been a good place to be, because that means you would have, if you were, stepped in retirement, you didn't know it was going to happen. It did happen. Now you got 13 years, you didn't get any growth. You were told, historically the markets always go up. They didn't go up. And here you are, I mean, I hate to tell you, retirement, you're on your own. You got to realize that the markets do two things. They go up and they go down. And if they go up, you have no problems. If they go down, you're going to have some problems. And not only that, you got to recover from that. And that to me is, that's not even a retirement plan, because, I'm investing in the wrong instruments for the phase in life that I actually need income, and I'm actually investing in instruments that does not provide income. They provide growth. They don't necessarily provide income, and that's what I find most people do. So if this makes sense to you, I'm going to get a commission report in your hand. It's worthy of giving this out again this week from last week's show, which we're going to kind of scratch the surface from last week and then segue into more income stuff this week that we didn't talk at all about last week. But if you would like to know more about market history and why it's so important to plan for downturns just as much as upturns, then I got a great commission report, Understanding the Market History. You can call 888-930-1080. Again, that's 888-930-1080. We will mail this or email it, whichever you prefer. Again, that number is 888-930-1080. You're actually dialed in to the Retirement Income Source. This is Tim Sparks, and today we're going to be talking a lot about making sense on income. See, if you're a retiree or even a pre-retiree, this show is extremely important, especially the talk that we're going to have today. And if you're looking for more mileage out of your money, I just know that this actually works. I spend enough time doing enough research to know that it works, and that's what really matters, right? If something can be fixed, why try to go change it and try to figure out other ways to just please people? And sometimes, I think sometimes we have to realize that our emotions sometimes drive our decisions, including finding financial advisors. And sometimes you may be at the wrong place, because they may not be an income advisor. They may be more of a total return advisor, and that could lead to a very disappointing future retirement. Anybody can get a retirement plan right in the first 10 years. Anybody can. Heck, I don't even need to hire an advisor, and I should be able to get it right the first 10 years. But I'm more concerned of how much money I'm going to have year 15, year 20, and year 30, just as much as I am early on. Not only that, you should be concerned because inflation is kind of a problem. That means your income or your balance should be actually growing. Well, let me share something with you. I don't know how many times people come in and they tell me that, there's the softwares and stuff that are being used today. And I actually am very familiar with software. I've actually used this software. And by the way, keep in mind, the first 14 years in the industry, I used software to give people comfort in knowing I felt like that I was giving the right advice. If I portray what your balance is going to look like. Let me give you an example. Let's just say you invest $1 million with me, and I say, okay, you're going to take out $50,000 a year. I'm going to run this through some Monte Carlo analysis, give you the good, the bad, the worst, and all that included. Turn it all around. You're a novice. You don't know what all this industry standard tools that we're using. And not only that, we can kind of somewhat manipulate, the advisor can, the actual return on your money, because, by the way, you need an actual return to be able to create the predictability of that 30-year scenario on that software. And that's what I don't like about it. I can put 5% in there. I can put 7%. I can pull out spreadsheets. But you got to keep in mind, whenever you say I'm going to average 5% a year, averages doesn't work that way whenever it comes to market-based investments. Averages are actually just the opposite, and the math completely changes too. Because see, if you're taking out 5 and you're averaging 5, right out of the gate, you should be flat, right? If you had $1 million, 30 years from now, you still have $1 million. That's not how it works. Because between 2000 and 2024, for the last 24 years, it's a bear market and a bull market combined, the average return was around 7.25%, 7.5% of the S&P 500. And that's where you're taking all the risk. And if you took out 5, you're probably thinking, oh, wow, I mean, that's pretty good, isn't it? I'm still walking away with 2.5% on average. And see, that's true. It's only true if you leave the money alone. Then that return will come out as a 7.25%, 7.5% return. I've done the analysis, and this is real returns, factual data, S&P 500. I got all the stuff on, but as soon as I apply the math to it, did you know the return changes quite significantly? It's not a 2% margin that you're making on your money. Actually, the account balance drops from $1 million taking out 5% a year to 2/3 less, if not more. And I'm talking about factual data, people. Do you know most funds typically don't underperform the S&P 500? Majority of them actually do. Over 90% of them. And about 99% of the people's portfolios out there are trying to beat an index. And so if we're going to go along with that, and not only that, you can't actually invest in the S&P index itself. You got to invest in funds or ETFs that actually mirror that index. And so if I use the index, the calendar returns on $1 million, take out 5% a year, I got just under $400,000. So much for the 2% spread. Because if I was averaging 2% spread, then my $1 million should be worth what? $1.5 million? Whatever that calculates to. Just a pure guess. That's so much for relying on average returns. It does not work that way whenever you're taking withdrawals. So if you would like to know more about income first methods, in other words, how to be a person that can go in retirement and spend interest and dividends and satisfy their income needs, take that $50,000 out where it should be coming from. You're going to get more mileage out of your money. I got an excellent book, my book, Retirement Income Shift, that shares with you a lot of those strategies that we do with our clients and helps you throughout the process of what that looks like. And I got a free copy for the first 5 callers of today's Retirement Income Source by calling 888-930-1080. Again, that's 888-930-1080. We'll mail this out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks. We will be right back. Welcome to the Retirement Income Source. This is Tim Sparks, and our show is sponsored by Sparks Financial Group, serving the heart of the bluegrass, Lexington, Kentucky, Louisville, and northern Kentucky and central Kentucky markets. Thank you for listening to our show today. And today we're talking about making sense on income. Why income should be the first thing you're looking for, just like it is if if you're like me, and I'm willing to bet you majority of you are like this, probably all of you are like this, if you want to invest your money in a CD, do you want the highest rate of return, wherever that bank may be, or do you want just any kind of return? Well, that's a silly question to ask anybody. We want the highest return. Well, if that being said, think about it for a moment. You need income, so should that come from the highest return that you're going to expect to get, more likely going to get, more reliable, what we call the bird in the hand approach? Or do you want some of that, or maybe most of that, which most people on our listening show are probably getting their income from? They're really relying on capital appreciation, which really means one thing. Every month, you're spending about anywhere between 60 and 75% of your principal and hoping you're going to replace it each and every year. It's like a farmer slowly but surely selling acre by acre of his farm to the point where he may run out of acres before he runs out of life. It's the same concept. You own shares, shares creates income. If you have less shares, like the farmer that has less acres, they have less crops to grow what they got left. It's the same way here. You're eroding your principal slowly but surely. And I hate to tell you this, 99% of the time, this is exactly what I see in people's portfolios. To some extent, it makes a lot of logical sense. But a lot of times people think, well, I'm giving up some kind of return here I'm afraid of. Well, if you listen to last week's show, that's not necessarily true. Well, because I talked a little bit about total return, and I was comparing the dividend aristocrats S&P 500 fund, what they call it S&P aristocrats fund, I should say, for the last 25 years. And in other words, it pays more dividends. It's a little bit more focused on dividends. And also, you take lesser risk, where you're taking more risk if you compare it to the more of a growthier type of an index like the S&P 500. So what that basically means is if you're taking income from the S&P 500, let's just say 5% a year, you step into retirement, you don't know what the markets are going to do. You look back and heck, we're all geniuses when we look back, but you got to keep in mind, we got to look forward whenever we're actually investing our money, because we're looking forward, nobody knows. You don't know what the markets are going to do in 6 months from now or 3 weeks from now. Neither do I, neither does your financial advisor. To some extent, nobody does, and I don't care what kind of favorite business and finance channel or whatever you look at. We like predictions, but predictions a lot of times could be completely wrong. I don't know how many people I've talked to that, especially in their younger years, would invest money in speculative places and then they wind up losing it all. Well, they learned very quickly that you just don't throw your money in a black hole and expect it to come out. You'll always come out ahead. But whenever you go into retirement, you even want to pay more close attention to where you invest your money. And if you're trying to satisfy the problem called income, then I would encourage you to actually invest for income instruments that actually pay income. What a novel idea. But when you go into risk and total return, and if I had no income to choose from, but I do, people that listen to the show do have income options, I would prefer to have my money in indices that have lesser risk, but also more, as much, if not more, potential growth. And I do that through dividend growth. I mean, I was looking at an article the other day. It was from Warren Buffett. Here's how much dividend income that Warren Buffett received in 2021. He goes through and talks about the dividends. He created his wealth through dividend investing. He started out just like most of you when you first started investing money. Only difference is he turned into a multi-billionaire. But he started with dividend-paying companies. And he still has a lot of those dividend-paying stocks today that he's held on for over the years. So dividends play an important role when it comes to growth, even if you're starting young. Matter of fact, if I had to do it all over, I'd rather have dividend growth and some growth, but I would have a little bit more in dividend growth than I would growth if I'm trying to create wealth. Why? Because historically speaking, dividend growth typically outperforms actual growth. Maybe a year or two growth can outperform. But I'm talking about, keep in mind, we're talking about long term, not short term. Any instrument can do well. Any hog can find an acorn in the short term, but in the long run, I hate to tell you, typically it's really hard to beat the S&P 500. But there is instruments out there that have actually done that, and you can go back and listen to my show last week, and I actually cover that through a particular and dividend strategy that's got real returns. But as we segue as going into income, as we go into the second part of today's show, we'll start talking a little bit more about bonds and bond-like instruments. I have been talking about stocks for the last month or last couple of weeks, and I should, because a lot of people people want growth and income, and I wanted to let you know that there's better, more lesser riskier ways to do that than what people are actually doing today. I get it. It's great to make a lot of money, but it's also you got to be prepared to also lose a lot more money because the pendulum can swing and go the different direction. A lot of times it's hard to stop it once it starts. And so I'd like to get a commission report in your hand and understanding the formula, especially a successful formula for a retiree. Total return equals I plus growth. And you can get that commission report by calling 888-930-1080. Again, that's 888-930-1080. We will mail this or email it, whichever you prefer. Again, that's 888-930-1080. I'm Tim Sparks. This is a retirement income source. And today we're talking about making sense out of income. And especially if you're going in retirement, you got to have income to be able to replace those paychecks that you were once receiving when you left work. If you're a retiree or even a pre-retiree, you really want to focus on this show right here, because we're going to be talking about how to get the most mileage out of your money, reducing your risk, by the way, and also potentially even having a better opportunity for growth because you're not giving up your principal, your hedge that provided that income in the first place. It's kind of like a landlord that owns rental property. They own rental property, they're getting income because of the rent that's coming in, but they still own the property. Most people, when they go into retirement, they're not necessarily doing that. They're actually spending the growth and calling it income. That's not an income plan. That's a plan that's going to run into it. There's going to be a time that the growth is not going to work out for you, and you're going to have to change your spending habits. Not a good thing to do whenever you're in retirement. Not a good thing to do when the inflation is still going up. It doesn't change. It doesn't stop in its tracks. Matter of fact, 2013, when the market took a 50 and 60% hit, inflation still went up about 35% during that 13-year time frame. That's why you need to be concerned with down markets, because it's really hard to recover, because you need income to replace the things that you're going to do. I mean, think about it for a moment. Most of us are somewhat prideful. And, if we got things that we do, we don't want to unimpress our friends or whoever. I'm not trying to say we keep up with the Joneses, but, we don't want to stop going out to eat 3 or 4 times a week, or, maybe giving money to our kids or our grandkids through school or in education, all that. I mean, we still want that money to continue to come in, but you got to still understand you have to plan for worst case scenario, not for best case scenario, so those things doesn't change. Because they will change. You'll start making excuses when the markets come down. Because very seldom ever meet somebody that lowers their spending habits in down markets. I've seen it. I've worked with people for a long time, and it's just a natural response, because it's most importantly, it's really emotional with a lot of people. But if you would like to learn more about income first methods, in other words, how can you get income and then still potentially get growth? and reduce your risk potentially at the same time. Well, you got to do that by having instruments that will help you to be successful in retirement. The more defensive, and defense creates offense. And so if you'd like to learn more about that, my book is available to you, free book offer, Retirement Income Shift, how to get the most money or the most mileage out of your money. After all, most of us, 60 or 70% of the people are been surveyed, retirees do not want to run out of money. Well, how do you do that? You got to put something in your favor on those withdrawals. Why not withdraw actual interest income or dividend income versus withdrawing your principal? It does not make sense to me. And if you are one of the first 5 callers, you can call 888-930-1080. Again, that's 888-930-1080. And we'll mail this book out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks. We'll be right back. You're tuned in to the Retirement Income Source with Tim Sparks, and our show is sponsored by Sparks Financial Group, serving both Lansing, Kentucky, Northern Kentucky, Central Kentucky, and Louisville. And today we're talking about making sense on income. Well, there's a lot of income planning out there, but when it comes to real income, I've only seen very, very few people that are actually investing that correctly. And a lot of it is because it's not really your fault. It's really where you're getting your advice from. Because I can put money in the bank and withdraw it and call it income. It don't mean anything. If I put it and replace it and put it in my checking account from a savings account, that's income. It doesn't really mean. Question is, how much of that was interest? How much of that was really just returning your own money? Well, if you don't want to return your own money and get more mileage out of your money, then you got to kind of have the chicken and egg approach, right? You want to eat more. You want to start eating eggs and keep your chickens. And the less and less you reduce your chickens, the more and more eggs you're going to continue to get. Now, it doesn't mean that you can't spend principal. And for those of you out there that are taking out, 7 or 8% of your portfolio, you really want to listen to this, what we're saying, because if you can get 5% from the burden of hand, you only need to get 3 from principal. Right now, most people, 99% of the portfolios I see today, are taking about 7% of their principal and only getting about 1% in dividend. That's not an income plan. That is a portfolio destruction plan. That's where the balance eventually is going to go to zero, and then you're going to have a very disappointing latter part of your retirement life. And keep in mind, don't underestimate how long you may live. I think sometimes people do. So I had a client come in, and they had a portfolio. They had about $920,000 or $30,000. Met with them about 5 or 6 months ago, and they were with a very respectable firm. Has nothing to do with the firm. This is not me knocking the firm. I'm just trying to tell you the difference between income investing and non-income investing. And a lot of times it's really we really don't even want to. We won't take on any client until they understand what it is we're talking about. I'm not a big fan of just you blindly taking a leap of faith without not knowing. I want you to own it, and once you do, and once you understand it, I think you're going to. It makes it a lot easier when we do our client reviews, because now they understand why we invest for income. Because after all, you've got a problem. You don't want to be spending principal and then slowly but surely seeing your principal erode, and you don't even know it's happening, but I know it's happening as a financial advisor. It's a reason why we decided to give people income advice in the first place. So with this couple, on this $930,000, they were getting about $8,000 a year in income. Now, when they came to me, they said $8,000 They didn't know that they were getting $8,000, but they were told that they can take out $40,000 a year. Well, the advisor that they were working with was kind of young. So in other words, if you're dealing with a younger advisor, you got to keep in mind they're probably bigger risk takers than you are. And so they probably are giving advice to everybody they come in contact with, and probably their own generation, which should be taking more risk. After all, dollar cost averaging works better with growthier stocks and stuff than it does if you're dealing with bonds and income-like instruments. And so what they felt like, what they told me, they were feeling resistance with this particular advisor about after they had read our book and stuff like that we offer on this show, about income-based investments versus growth investments, and they finally start figuring out that they were in more growthier type instruments. So they decided to take us up on the retirement risk report. Now, I kind of gave you heads up what really was going on there, but they were only getting $8,000 a year. Well, I knew how much income that our clients are getting on $930,000, but obviously, I got to help them to see that. They don't even know how much income they're really getting. They read about income. They understand about the I, not the G, being income first methods, and so that's what we uncovered in the retirement risk review. This is, kind of like an X-ray for a doctor. It's something that I can get more certain of once I can, have the right data to be able to provide this report. And this report is so simple, a caveman can figure this out once they understand it. And not only that, I give them examples of what an actual portfolio looks like, because we got several clients that are got equivalent of $900,000 portfolios. And so that's what we also showed them, the proof in the pudding. And then, that existing portfolio, what it was providing today. So, and that's kind of the icing on the cake once we got to that point. So once we showed them the income, the differentiation, and why this show we're talking about why income is the higher priority and making more sense out of income, because they didn't want to touch their principal, but they were going to if they was to spend $40,000 a year. Imagine you're taking out 40 and 32 of it's coming from principal. You have to make that up every year in growth for what you got left. And that is not as easy as you think it is. Only way you can make that up every year is if the market goes to the moon. Well, the markets we already know doesn't do that. And so, who wants to go through retirement and then one day down the road they now know they would have made a bad decision if they would have stayed the course, and then sure enough the markets did take a downturn, because it does take downturns and we have to be prepared for that. So we can get them $45,000 a year or a little bit more than that. So I just rounded the numbers off. They needed $40,000, so they wind up walking away with about a $5,000+ surplus, which means they can actually still dollar cost average. They can reinvest that money back into their portfolio, because they really need that. They only needed $40,000 on that $900,000. Well, you tell me, would you rather spend it in real interest income, or would you rather spend it, take 3/4 of that of your own money out to give you the same income? I don't know about you. I'm pretty sure you probably already answered that emphatically. You would rather get real interest income. Keep in mind that income occurs every year. It doesn't stop just because we just got lucky the first year. It's year in and year out. So for the next 20 or 30 years, you need a long-term strategy. And so it's the reason why I got a team of people with me that helps me to help our clients to provide them those long-term strategies, and we constantly manage their portfolio to do that for them. But I want to get a commission report in your hand, because really it's all about knowing what type of advisor actually deals with income. And, this commission report is called 10 Warning Signs of Working with the Wrong Financial Advisor. Most financial advisors, don't mean to be critical here, we're all in the industry to make a living and help people to get through retirement. Doesn't mean that they're, I'm attacking their character. It's got everything to do with the advice that they're actually given. And so this commission report kind of helps you to see that. And you have to determine that. It only takes one advisor or the advice given to you from the advisor to really screw up a retirement. It don't take 2 or 3. A lot of times you don't get do-overs. So you wind up having a very disappointing midstream retirement because you wasn't prepared for the downturn that will eventually occur. But that commission report can be yours if you call 888-930-1080. Again, 888-930-1080. We'll mail this or email it, whichever you prefer. Again, 10 Signs, Rome Financial Advisor. Great read. Helps you to understand how our system works. The very system that I used to be in for the first 14 years, why I decided an income specialist is the only way to help a retiree to get more mileage. Great read. 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks, and today we are talking about making sense on income. Now, let's talk a little bit about the difference between bonds versus bond funds. And if you're dealing with other bond-like instruments, they're very similar. There are 2 different contractual instruments that provide contractual income as far as market-based that I'm aware of. I'm sure there may be others, but these are contractual. These has got a history, been around a long time, bonds and preferreds. Well, let's talk about bonds, okay? Well, bonds, the reason I like them first and foremost is because if you're invested in bonds right now, you've got bond funds. You're not actually in bonds. So you got to keep in mind there is a difference. It's the reason why it's so important to get our commission report on the distinction of the two. And I'm going to go a step further. I'm going to hit you square in the eyes here today about the difference between these two. Earlier, we talked about CD interest. Let's just say, I got a bank on the left, and I got a bank on the right, 2 different corners. One of them is advertising 5.5% CD rate, and the other one is only advertising 3.5% CD rate. Which one of those are you going to probably invest your CD money into? I hope you said 5.5. It's a no-brainer, right? Well, first and foremost, acknowledging and understanding whether you're in actual bonds versus bond funds was that distinction. I'm giving you the actual returns today of a bond versus a bond fund. 5.5 versus 3.5. That should be the first and foremost the reason why you would want to invest in bonds over bond funds. Not only that, it goes further than that. Bond funds, you don't get any kind of guarantees. And only that, the returns at 3.5%, if that's what they're advertising today, using this analogy, then 3 or 4 years ago, that same fund, I'm talking about one of the top funds in America that a lot of people have their money in today, and I'm not going to give the name of it. It's a very inexpensive fund, and it's generating 3.5%. But 3 years ago, or 3.5 years ago, when rates were down, that yield was around 2.25%. What that means, and that should tell you that the yield is unpredictable. It's always going to change. It changes based on interest rates, just like mortgage rates. Right now, mortgage rates, are they higher or are they lower? They're higher, right? Well, it's the same way it is when you're out looking for income instruments. Income instruments there are several different types of income instruments that pay longer term rates and higher yields. Why would anybody settle for anything on the short term? It doesn't make any sense to me. Yeah, true, you can get bonds that pay 30 years worth of interest. U.S. Treasuries do that. You get 15 years, you get 10 years. Heck, they make bonds out there that pay even longer. Well, there's a lot of risk. You don't want that long of a range, right? You want kind of like midway through there, somewhere between, we like anywhere between 3 to 10 year time frames. Why? Because we always want to be trigger happy. We want to change whenever it warrants the time to make changes, so that way we can continue to stay update with the current market environment. And you want to do that with short term. Well, you got to be an analyst to be able to do that, people. You can't do this on your own. And I'm going to tell you a lot of the reasons why as we go. If I don't finish it today, I'm definitely going to start talking a little bit more about why it's important to hire an analyst for this right here, because there's a distinct difference on the amount of return you will make on these bonds, because there's more to it. A lot of people really don't know a lot about. They've heard about bonds, so they'll shortcut it, buy bond funds, and call them the same thing. They're not. So right out of the gate, if you had $1 million in bond funds, and you just say, I don't want a lot of risk, I'll just take the reduced risk, buy a good investment grade bond fund, you're going to get today around $36,000 a year. Pretty good, right? Well, keep in mind the yield or the income that can actually go down or can be reduced. If it reduces back where interest rates go, let's just say close to zero, like they were several years ago, that could drop, and now your paycheck can drop from $36,000 to $22,000. That's what I mean by bond funds. They're all over the map. They're just going to follow and mirror kind of where the interest rates are done. When you buy an individual bond, and especially today, while they're discounted and at a much higher yield, then you could have easily gotten $55,000 for the same money. And not only that, the discount is extremely important too. And I'm going to talk more about that here just in a minute. So if you would like to learn more about income methods, why I choose and use analysts, not financial advisors. I'm a financial advisor. I'm not going to try to go out on the limb and get people income instruments. I'm not good enough to do that. Yeah, I can guess and probably maybe get a little bit more right than you. And some of you are really smart and sharp people that not got nothing to do with question your intelligence. But at the end of the day, you got to keep in mind investing for income does require a specialization, just like heart surgery requires a heart surgeon. But if you would like to learn more about income first methods, my book is available, Retirement Income Shift. Made #1 Amazon for 3+ months in 6 different categories of personal finance. I got a free copy for the first 5 callers of today's retirement income source. Call 888-930-1080. Again, that's 888-930-1080. When we come back, we're going to talk more about why discounted bonds, where they're at today, is by far superior than it is why anybody would want to own a bond fund, because it doesn't even make sense. You're tuned in to the Retirement Income Source. We'll be back. You're dialed into the Retirement Income Source. This is Tim Sparks. Our show is sponsored by Sparks Financial Group, right here in the heart of the Bluegrass, Lexington, Kentucky, serving both northern and Kentucky and central and Louisville markets. Today we're talking about making sense on income, especially if you're a pre-retiree or retiree. You want to really pay close attention, because income is more than likely a problem you need to solve going into retirement. But the question is where is your income really coming from? We offer a retirement risk review, which anybody can always call in any time and actually request that, and that's where it starts off with a phone call. But you got to have some information with you before we start diving in and telling you how that would look like. Just like I had shared with you earlier of the couple that were getting about $8,000 a year in interest and dividends on a very well diversified portfolio, very astounding company, so forth, and we were getting over $45,000 with the same money. Think about it for a moment. That's a significant pay raise. That's like part-time income versus full-time income, and it's doing nothing but just being more income focused in retirement, because that's a problem that most of you, I'm sure, is probably trying to solve. So earlier, just before our break that we had just a few minutes ago, I was talking the difference between bond and bond funds. Keep in mind, people, bonds really and truly is not an appreciating asset. Yeah, there's convertible bonds and stuff out there, but most people, if it was me, I wouldn't invest in those. I'd rather prefer to invest in, stocks or stock paying dividends if I've got an income problem. But typically bonds are kind of like CDs. It just are guaranteed by an issuer. An issuer could be Coca-Cola, Pepsi-Cola, Anheuser-Busch, you name it, whatever the company may be. They got to be large enough to be able to offer bonds. You loan them your money just like you do a bank. You loan them money. It's called a certificate of deposit. It's the same thing. Well, there's three different values what you pay and invest in a bond. There's only one with the CD. CDs, you're always going to be par value. Whatever you put in is what you're going to get back plus the interest that you make. Fixed annuities are that way. Same way as CDs. They're par value instruments. But bonds have some kind of, sometimes more of a distinct advantage depending on whether you buy them at a discount or you buy them at par or you buy them at premium. Well, if you buy one at premium, that means you pay more for the bond. You're going to get less at the end of the maturity period. To me, I'm not going to buy that kind of bond. I don't care what kind of income they give. I prefer to buy them more at a discount. Why? Because I actually get two sets of guarantees based on, of course, the issuer of that bond, and there is no default. So you get two guarantees. You get return of your money and return on your money. So if they're offering you 5.5%, they're going to pay you 5.5%, let's just say 10 years. So that's 5.5 times 10 years, that's 55% on your money, not including the gain. The gain is extremely important. So if the gain, if you bought it at a 10% discount, that means you're also going to make an additional 10% at maturity, which means you made an additional gain. In bond funds, you don't get those. Keep in mind, just like I said earlier, you really want to know the difference between these two because you will definitely easily give yourself a pay raise by investing in bonds. But most of you don't have actual bonds. You have bond funds, and there is, again, a difference in income. And so if that was the case, then you really want to do your research because actual bonds, since they pay more income, keep in mind, if you're going to invest in them, you then might as well invest. Why? That's because that's exactly what they do. They pay you more income. And I got a commission report I'm going to get in your hand called Bond versus Bond Funds. It goes into this a little bit more and helps you to understand the distinct difference between those two. I'm giving you actual returns, what I'm seeing today's market environment, and why it's so important to take advantage of it while the interest rates are still up, because these are long-term instruments and they typically are discounted right now. It's a great time to be buying, so that way you can get the gain and the interest. But that commission report can be yours. We'll mail it or email it if you call 888-930-1080. This is Tim Sparks, and today we're talking about making sense on income. Keep in mind that contractual instruments are really more of a paper loss like type instrument when you're dealing with bonds and you're dealing with preferreds. Why? You just hold them to the maturity and you get all your money back that you had invested. If you had a discount, then you get not only the money back, but you also get a gain on your money as well. That's the difference. That gives me slightly more predictability, and most importantly, I get a higher reliable income than I do if I choose bonds that are inside of bond funds or bond ETFs. It's like I'm taking a pay cut, and I don't understand the point of it. But 99% of you, I hate to tell you, are more likely investing in these, and the whole point of investing you in these is just to keep your risk lower. That's all the reason why they're doing it. But from an income perspective, they don't have much growth at all. Matter of fact, bonds are typically are not made for growth. Then it really doesn't make a lot of sense to invest in a lesser income when you can get more, and not only that, contractually get a return back on your money, plus including a possible gain. That's why I like bonds over bond funds. If you add an analyst to that, that's even better. You see, analysts basically assess investments, they manage risk, and their goal is improve profitability. And when they're in the top 1% in the specializing in something, and that's all they do, then more than likely you're going to be more right than you are wrong by actually using an analyst. That's the reason I use them. I'm not going to sit here and try to make our clients think that I'm all it in a bag of chips. And to be quite honest with you, I don't kind of care what kind of credentials somebody has out there that are giving financial advice to clients day by day, because they're not doing you a good a service anyway, because they can't be talking to you while the markets are going up. I mean, think about that for a moment. That means things could happen critically that can make a difference on that very day that something could happen with a particular company, and they're not watching them. So what they basically do is they ride on the coattails of what we call the disease of ease, and just put you in mutual funds, which basically you can do yourself, save yourself the money, paying them for doing something you can do yourself. But if you want to upgrade and get a much better, more beneficial portfolio, one that's more custom to you, and also have a higher probability of better profitability, then you want to have something. You want to find a firm that can actually have analysts that are actually managing their clients' money actively, not just set it and forget it. And that is extremely important. So if you would like to learn more about income first methods that make sense for retirement, this book teaches you how to get income consistently in an up market or a down market, and those are using defensive income strategies. The income doesn't change. And this is my book, The Retirement Income Shift, Getting the Most Mileage Out of Your Money. Amazon bestseller in personal finance for 3+ months. Just came out back in October. And this book can be yours if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. Again, that's 888-930-1080. We'll mail this out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. We hope you've gotten a lot out of the information today, out of this show. I mean, this year I'm going to elaborate a lot more in what it is we specifically do. Keep in mind, we're not actually giving financial advice. I'm hopefully giving you some analogies and stories to relate it to what we do, so that way you can kind of understand the difference between income investing and then other types of retirement income investings that are really just nothing but giving your money back to you. We thank you for listening to our show. This is Tim Sparks with the Retirement Income Source. Look forward to next week's show. Thank you, and be safe out there.